Hey, good afternoon, guys. It is 2:30 p.m. on Saturday, March 9th, 2019. Hope you guys doing well. I had a great week trading. I'm going to do something a little bit different today in this video. um, as you guys, if you've watched any of my videos over the last year or two, again, I don't make a lot of them, but you know that I trade primarily a combination of fundamental analysis, keeping an eye on what's actually driving prices. And technically, I use a lot of Elliott waves, so I kind of use both. And it's again, if you're taking longer term positions or want a longer term view of the market, I believe you definitely have to know fundamentals and at least be aware of what's going on. And whatever technical system you use is fine. I just prefer Elliott wave for reasons I've discussed in the past. But I wanted to do something a little bit different, and this is really more just straight technical trading, and it's really probably going to be short-term trades like that you might be out in a matter of hours, um, and they operate down on the 15-minute time frame, which again, for the trading I normally do, I would never trade on that low of a time frame. I start, top-down analysis from the daily, maybe sometimes the weekly on down. But for the purpose of this, you need to use the short time frame, and about 15 minutes is good. And you can do this on MT4 or on any other platform. I'm going to show you on TradingView just because I like to be able to manipulate the charts a little bit easier on TradingView, but you certainly can do it on MT4. I trade on MT4, that's my broker, but I subscribe to TradingView because it's just they're just better charts. They'll visualize better, and you can just do more with them, but you do have to pay for it. So, but like I say, you don't need it. Anyways, and you guys probably, if you've been searching around on YouTube or other places where there's Forex trading, you may have come across something like this before, but I have a little slight twist on it that I think is important, just understanding market liquidity. And so I'm going to work that into the discussion. So let's go to the charts here. So what we have here is a 15-minute chart of the Aussie yen. Now, I'll tell you briefly what this is, and then you can see if it rings a bell of anything you've seen before. There's a period, normally the Asian session is very quiet. So from about the time that the New York session ends and until the London session starts again, and wherever you are in the world, obviously those times are going to be different. I'm on the East Coast of the U.S., so the New York session ends at 5 p.m. New York time and the London session starts at 3 a.m. New York time. So that period in between 5 p.m. and 3 a.m. is the Asian session. And it's not that you can never get trades on the Asian session. If there are trades, if there's news that comes out on the Australian dollar or the Kiwi dollar or sometimes the yen, you will get trades during those times. But normally, it's a very quiet time in the market. It's what they call the interbank time. It's kind of when the large banks, central banks, and everything are kind of leveling up with each other and setting the stage for the next trading day. And it's just a quiet time in the market. Plus, the active trading at that time is in Tokyo and Sydney, and it's just lower volume, lower liquidity. So you just tend to see the market moving more sideways. Now, again, you will see price action like this week we had on Tuesday, New York time, 8:30, we had Aussie GDP, which came out worse than expected. And if you look at any of the Aussie pairs, going back to, let's see, what was that date again? That was March 5th where I am. So if I go back to March 5th here, and we'll find this. So right here, this was the Australian news, and you can see it was negative. So this was obviously during the Asian session. And so the market went down. So this would not be what I'm talking about here. So you need to keep an eye on the calendar when you consider these type of trades. And if there's anything happening during the Asian session as far as major Australian dollar news, New Zealand dollar news, maybe Japanese yen, or if there's anything sentiment-wise that comes across the wire, which that's less likely, but it can happen. But generally, you want to just watch the economic calendar. And if there's any market-moving news, then these type of trades won't happen. So basically, what I do is, if I know there's Australian or New Zealand dollar news scheduled during the Asian session, I probably just won't look for these setups on any Aussie or Kiwi pairs, or maybe even yen if there's any yen data. But that still leaves you a lot of other trades. Okay, so that's the first thing. So be aware of what's on the economic calendar and know if there's anything market moving that's going to blow up this scenario, such as you saw right here. So because this is the Asian session starting from about here, right, let's see, yeah, right here, and then you can see it went down on this news. So all right, so that's the first thing. So what you want to do, first of all, is put the period separators on your chart. You see these vertical lines? These are the beginning and the ending of the trading sessions. So this one here is 5 p.m. New York time. So because that's when the Asian session starts. Okay, it's the end of the New York session, and it's the start of the Asian session, which is the beginning of a new trading day. So each one of these vertical lines represents a new trading day, which is, again, where I am, it's 5 p.m. New York time, but that's the start of the Asian session. And then it goes all the way to the next one. So all this in between here, okay, is a whole trading day. So this is 24 hours in between here. Okay, I'm on the hourly chart right now. Okay, so you want to put that on your chart. And if you're in TradingView, it's really easy. You just go to settings and you just check setting breaks, and you can change the color and whether you want solid lines or dash lines right here. But that's how you do it. On MT4, you just right click in your chart, go to properties, go to common, and then just click show period separators. Okay, and hit OK, and you'll get the same lines. That's what these are on here. Okay, so you can do it either way. All right, so I'm going to go back to TradingView. All right, so that's the first thing you want to do. Put these line separators on your chart. All right, next thing you want to do is you want to go down to the 15-minute time frame. Okay, now here's a little twist on this. Other people that I've seen do this, they start looking for the trading range around the start of the Asian session, which again is this vertical dotted line right here, okay? And then they look all the way to the beginning of the London session, which is right here, okay? So you can actually move this back, so let's just do that. So for me, that's 3 a.m. So here's this box right here. And then I'm going to draw this up and I'll tell you why. Okay, so you want to get the trading range that was happening. So again, normally this is really quiet. You can see this kind of just chopping around inside this box and actually continued for about another, even, this is the start of the London session. This trading range actually went on for until the beginning of the New York session. And this is possible where you'll get this trading range continuing. Sometimes you'll get a move right at the beginning of the London session at the first hour or two. Sometimes it might be 2, 3, 4 hours later in this case. So, I could extend this out just for the purpose of this example to here, but for realistic purposes, I want to just keep it at the beginning of the London session. So right here. All right. And then you want to adjust the box so that it captures the highs and lows within this time frame. And I'm going to talk about this edge over here in a second. So it's actually more like this if you want to include this wick. Okay, if I didn't want to include that wick, I can move it up to here. But so either way, if you're more conservative, you can lower it down to here. And this needs to be basically right there to capture this low over here. Okay, so like I said, guys, normally people will, if they're going to use this, they will draw in. They're going to look at the range from the start of the Asian session to the start of the London session. Now I go back further. Okay, I go back to the end of the London session the day before. So for me, that's noontime. Okay, London closes at noontime on the East Coast. So from here to here, This in here is the afternoon New York session. All right, only New York is open. London's closed, Asia hasn't opened yet. So this is end of the London session to the beginning of the Asian session, all right, the afternoon session for New York. And you can see the market tends to go to sleep during that time too. They're really small candles, just kind of not really doing anything. And you'll see that's pretty common because once London closes, London is the highest liquidity in the market. Once London closes, unless something comes across the news, like a sentiment, something across the wire, that's sentiment related, that drives price, this is what you're going to see. Okay, so I told you the two things that could blow this up. One is scheduled economic news during this time, especially for the Australian dollar and the New Zealand dollar, or sentiment. If something unexpected comes across the wires, maybe something about Brexit, if you're looking at a pound pair, something negative or positive comes out, it's not scheduled news, then that can blow this up. But normally this is what you're looking for. So again, some people that do this will draw the box right here. They'll start it right at the Asian session and they'll go to the London session. All right, this is basically the whole Asian session. And then this the end of the Asian session, beginning of the London session. But I draw it back again till noon, till the end of the London session, all the way through to the beginning of the next London session. Okay, so for me that's noon time, so that's right there. Okay, so I draw this. Okay, so this is basically 10 hours right here from here to here. This is 10 hours of trading. Okay, because the New York London session ends at noon and then starts up again at 3 a.m. So noon to midnight is 7 hours plus another 3 hours is 10 hours. So from here to here is 10 hours. Okay. Now you can do it that way where you draw this rectangle and only look from the beginning of the Asian session, but I think you're missing some of the range and you want to capture as much range as possible. Okay, so that's how I draw it. And of course, you don't have to draw the box. If you can just visualize it, that's great too. But it's easier to kind of visualize it. Okay, so what you're looking for is price to be held inside of this range. So here's the low of this range. I'm not going to count this wick. All right, so here's the low right here, and then here's the high. So that's how I drew the dimensions of this box. This is the time frame, and then this is the height of it. Is based on the lowest low and the highest high during this time, minus this big wick. And again, if you wanted to be conservative, you could draw it down and capture this too, but I'm not going to. And so then what you're doing is, once London opens, you're looking for a breakout from this trading range. So as long as price, so because this continued on, I am going to extend this for the purpose of this example. So as long as price stays inside this box, there's no trade. Okay, and actually you can continue to stretch it over to here even. There's no trade. Okay, because price is still trading inside of this range. At this point right here, it breaks out. And we go down, and then we retrace. This is a nice little ABC, Elliott wave correction, ABC. And then we go down. Okay, so you could then take a short on this pair at this point, at the close of like this candle right here when it closes. As soon as the candle closes outside of this box, here you had a wick, came back, you had a wick, it came back, and we finally get a close, right on this candle right here. We finally close outside of the box. At this point, you would go short, and you'd put your stop just on the other side of this box up here. In case it came back up for a little while, you don't want to get stopped out inside. And this is only a 15-minute chart, so there's not a lot of pips in here. Okay, I mean the whole width of this box is only 36 pips from here to here. So you put your stop up here, be about a 40 pip stop loss, and then just let it ride. Okay, and you can see what happens. Market goes down, get a little correction, down, another little correction, down again. Okay, and then it turns around. Now let's see where this is. This goes all the way until almost 20 hours later. This is 2:30 in the morning the next day. So this move went on for like 20 hours. Okay, so and let's see how many pips that would have been. Got in right here, down to here, 62 pips. Okay, not bad on a 15-minute chart. All right, and so the next question is, well, how long do you hold this trade? Well, of course, that is entirely up to your risk management and what you're comfortable with and how many pips you're comfortable with. For me, because I use Elliott Wave, I would have seen this ABC. I said, okay, I'm going to hold this. And again, I'm just keeping my stop up here. I'm not moving it. Okay. Right now, I'm not moving. I'm just going to let the market do what it's going to do and go. Okay. So I'll give you a couple of spots where you might want to consider either taking profit if you're more conservative, or at least maybe starting like a trailing stop on your position. And to me, that would be, again, around the end of the London session again. So that's the 12 o'clock candle. So that's right here. But you see what you would have missed. If you had taken profit right here, it would have been very small and you would have gotten not much. Okay. So to me, once this breaks out, I'm going to hold this for a while. And I'm going to hold it at least through the end of the New York session, or through the end of the London session. Okay, that day. But on this case, you would have gotten very little profit, and you see what you would have missed. Okay, so what you could do is maybe put a trailing stop. And a trailing stop, if you don't know, is basically you can set it in MT4. And what it does is you tell it how many pips away. And as the price moves in your direction, your platform will automatically lower your stop. So let's say you set your trailing stop for 20 pips away. What it's going to do, it's going to put your stop loss 20 pips away from the current price. And as the price goes in your favor, your platform will automatically adjust your stop loss so it's keeping it 20 pips away all the time. So that if the market does turn around and you're not in front of your computer, you'll get stopped out, but you'll get stopped out in profit instead of keeping your stop up here, and then you go away from your computer, you come back and price comes all the way back up and stops you out for a loss when you had a really nice profit going. Now, of course, the bigger your trailing stop is, the more you're going to give back. 20 pip stop loss, if you off of here, it's going to come back up 20 pips, then you'd be giving back those 20 pips. But it's better to lose the 20 than to lose all of it and have a loss, right? But if you put your trailing stop too close, then on any little pullback, you'll probably get stopped out just to have the market continue in your direction. So it really depends what pair you're trading. This is the Aussie yen, not really a high pip pair, but if you're trading something like the pound Aussie, you might have to have, a 40 or 50 pip trailing stop. On a pair like this, especially on this time frame, 15 or 20 is probably enough, right? So you have to just kind of know what you're dealing with in terms of the volatility of any certain pair, how many pips it moves in a day. And you can see if I go to my MT4 chart, this is the pound Aussie, and this pair moved the last time about 161 pips. This is the daily average, 161 pips. And if I go to the Aussie yen, which is what I was just looking at on the other chart, the Aussie yen only moved 63 pips. So 100 more pips this pair moves versus the Euro Aussie. Okay. Excuse me, 70 pips more. Okay. Or pound Aussie. What was I was looking at pound Aussie. Yeah. Pound Aussie in that time moved 160 pips. The Aussie yen only moved 63. So that's what I mean. Like if you're going to use a trailing stop, you kind of have to know how many, what the trading range is on your, how much each pair moves in the course of a day. And there's ways you can do that. If you use TradingView, it tells you right here, 78, okay, 78, between 77 and 78. And this will tell you for any given pair. It'll show you, okay? So you can do that too if you want. This is a little indicator that I have on here. It tells me the spread. I don't really use pips to open or high to low. Really what I use is the spread and the daily average. And of course, this is the current price right here. So I don't have to look over here in these tiny little numbers. It's right here. So this is the current price, the spread. Of course, it's really high right now because the market's closed. It's Saturday. And daily average. I don't use these two, but this is a great little widget. So that works on MT4. So, all right. So that's really the story, guys. So you can go through any pair and find this. And I don't know if I drew. So here's another one. This is the, now this is one where maybe maybe it wouldn't have worked, right? Because, and I want to show you that there's no perfect system. So this is the Kiwi Canadian on the 15-minute chart. And again, so here's the end of the London session. So where I am, that's 12 noon. And then here is, go back. I want to go to the beginning of the London session right here. Okay. So, all right. So we have this right here. Now here's the range. So if you had waited, so now price is moving inside this range, moving inside this range, moving inside this range, and then boom, right here, it breaks out. You go short right here, guess what? You would have eventually been stopped out because look what happened. Price went back up. Okay. So this is an example where this is not going to work. And again, guys, anybody that just shows you all the good trades that work here is not being intellectually honest. So here's one where it wouldn't have worked because you would have played this breakout again from here to here. Here's the range, okay, and then price broke out right here. It had a little false breakout. It came back up. Then it comes down again. You're like, all right, here we go. It's going to go down, and then boom, it shoots right back up again. Okay, so that one wouldn't have worked. But I'm going to tell you another little hint here about this too, okay? And hold on, guys. I just got to pause this video just for a minute if I can do this without screwing anything up here. So 1 second, guys. Okay, guys, I'm back. I'm sorry. All right, so what I was saying here, guys, is if you had gone short here, you would have been stopped out. If you hadn't been watching your chart, you put your stop loss up here, you would have been stopped out, right? Up here. So here's another layer that you can add and make yourself a little bit more conservative and do a little bit more risk management. Now, you could take this anyways because, well, let me show you first. Very simple, guys. Go to the higher time frame and see what the higher time frame is doing. So I would say at least go to the 4 hour, if not to the daily. Okay, and understand that this pair is moving up. So see these little circles? That's our little box. You can see, now this isn't great. This isn't a great example because this is mostly moving sideways, but it is trending up. So understand that if you go short, okay, let's go back to the 15. If you go short here, you're trading against the longer trend. Now, it doesn't mean it might not work because this could keep going down on like a correction or a pullback. Maybe it's a reversal, who knows, and you could still end up doing okay. But in this case, the trend continued, okay? So you have to make a decision. So if you see this breakout, know in advance what the longer term trend is doing. And that's just going to give you a little bit more confidence and a little bit more favorable to your side if you know that the longer term trend is also down, okay? So this is a short-term technical trade, but it is trend following in a way too, although you don't have to follow the trend because, again, this is a short time frame. You're not holding this trade for a long period, and it could just be, you know, trading counter trend on like a correction to the longer term trade trend, okay, which is what this would have been, but it wouldn't have worked. Okay, so you know, if you had your stop loss sitting up here, you would have had a loss for sure. So you're going to have to just kind of weigh that, right? Do you want to risk this, or you want to just trade in the direction of the trend, wait for the breakout, and, you know, for confirmation of the trend continuation, and then go? Okay, your call, right? You have to decide that. I can't tell you that. All right. But just think about that, because in this case, it would have been a loss, right? And one more time, guys, I just want to show you what happens when you don't want to do this. So let's see. What did I say that was? March 5th. Yeah. Okay. So remember I told you if there was news during the Asian session, you don't necessarily want to do that because you're not going to have a nice clean range to work with. So here was the Australian GDP came out. No, actually it was here. Sorry. This is the day before. Yeah, this is the day before. Here was the Australian GDP. So here was the beginning of the London session. I mean the Asian session right here. And then if you had gone back to noontime, so let me just draw this for you. This is an example you need to know about the news. So right here is the end of the London session, okay, and then to 3 a.m., right, to 3 a.m., right there, okay. All right, now look what happened during the Asian session. The market broke out. So at 3 a.m. we had already broken out of this range, okay, and still going. So this would have been an example where I would not have taken this trade. And honestly, because I knew there was market moving Aussie news, I wouldn't even have looked at this pair. But this is where, I mean, certainly this is where your fundamental trading comes in, because the Aussie is weak, and there was weak data that came out, so you should have taken this long anyways, right, and sold the Australian dollar. But for the standpoint of what we're talking about with this setup, this is one where you would have passed on it, right? Again, if you wanted to trade this longer on the longer time frame, because just on fundamentals, it still would have been a great trade. But for the purpose of these examples, this is not a good example. So that's where you want to stay out, okay? So anyways, guys, I don't want to beat a dead horse here. You get the point. Take a look at some of these. Go back, put the period separators on your chart, and look at, again, draw rectangles connecting the highs and lows from the end of the London session one day to the beginning of the London session the next day. Connect the triangle or the rectangle with the highs and lows, and then wait for a breakout. And usually, that if there's going to be a breakout, it's going to happen between right at the start of the London session up to maybe 3-4 hours later. Usually between where I am, between 3 a.m. and 7 a.m., those breakouts will happen. And then you can just take them short term. You can take them for 2, 3, 4, 5 hours. Or if it's in the direction of the trend on the longer time frame, you can hold it. But again, make sure you go and look at what the higher time frame is doing and decide whether it's worth taking a counter trend trade. And if you do, just understand that it's a little bit more risky. All right, it's not that you can't take it, but it's a little bit more risky. All right, that's it, guys. Video is way too long now as it is, so I'm going to end it here. If you guys have any questions, please leave them below. Like the video, share it, and give it a try this week. Take some small positions, practice good money management, or do it on a demo account and try it out, see what you think. And it's just an opportunity to look for additional trades, especially if there isn't anything really going on the longer time frames, or fundamentally it's no news releases, there's nothing really to push the market. Some of these lower time frame short-term trades could be another opportunity to grab some pips. All right, guys, that's it. Have a great rest of the weekend, and look forward to talking to you guys very soon. All right, thanks.